Hello, everyone, and a very warm welcome to our lightning session on liability matching with UK commercial property. My name is Helen Lamb, and I'm a Membership Engagement Manager at the PLSA. I trust you'll find this an informative session, and if you'd like to view this again or any other of the content, you'll be able to do it on catch-up till the 9th of November. I'd like to welcome our speaker, Rupert Sheldon, who is Head of Core at Fiera Real Estate Investment Management. Rupert has particular responsibility for the Core and Core Plus funds and segregated account relationships that operate within the company. In addition to his property investment experience gained over 25 plus years, Rupert is also a chartered surveyor. At the end of the presentation, there will be a little time for Q&As, which take place in the chat box. We'll also place some helpful information there. Do feel free to post your questions in the Q&A box during the presentation. We also have some polls in the session, so we hope you will participate. And now, over to you, Rupert.
Thank you, Helen. Welcome, everybody. I'm Rupert Sheldon, as Helen has already mentioned. And thanks for joining us today to consider the place UK commercial real estate might have within the investable universe for pension scheme investors. Before I get going, a little housekeeping. I'm afraid I've recently had COVID, and I'm largely through it now, but I do have a little tickly cough. So if I do cough and splutter my way through at times, apologies in advance. But I'm going to start by identifying the challenges facing all pension scheme investors today. So could we move to the next slide, please? So the challenges facing all pension scheme trustees today are ones that we need to identify and relate to, and we need to work out what the solutions are, because we live in unique times. I'll come on and elaborate in a minute. And what might those solutions look like, more particularly the part commercial real estate may have to play in this? Now, traditionally, commercial real estate is considered illiquid, and it does carry specific risks, not always best aligned to a liability matching strategy. I'll therefore also consider how to effectively manage these risks within such a strategy. But before we move to consider the challenges facing pension trustees today, I'd just like to ask a question at the outset, and perhaps you can reflect on this over the next 10 minutes or so, and we'll come back to it again at the end. So if you do plan to invest in commercial real estate over the next 12 months, what percentage of your portfolio will you look to allocate? So the challenge, well, the UK pension scheme investor has had a very difficult period over the last 10 years. The global financial crisis, the COVID-19 pandemic, and endless amounts of central government stimulus and distortion, including unprecedented levels of QE, amongst other things, have left an investing minefield behind. Low interest rates and low investment returns at a time of defensive investing have driven global bond yields to historic lows and many DB schemes into deficit. This has created a demographic time bomb where increasing numbers of people are living for longer, and these are typically the retirees or the liabilities within a pension scheme, and they're needing to be funded by a proportionately reducing pool of workers or assets, if we're looking at the other side of the balance sheet of a pension scheme. Put simply, the requirements of the pension industry, particularly those of the DB segment, as well as the DC segment, are not being well served by the investable universe. However, the market has adapted over the past 10 years. The chart on this slide shows how liability-driven investing, or LDI as we refer to it, has grown as a segment of the UK pension scheme strategies over the past 10 years, with LDI making up around about 54% of a circa 2.6 trillion pot, and more than trebling since 2011. So how has this been achieved? Well, largely through an increase in private alternative investing into real assets, which enable liability matching through the creation of long-dated, secure, index-linked income streams, or bond proxy investing. So how does real estate fit into this, and how can it be part of the solution of this challenge of our time? Well, long income real estate investing can be part of the solution, and is increasingly seen as a high-yielding alternative to traditional bond investing. So what do we mean by long-income investing in commercial real estate? This means different things to different people. So at Fiera Real Estate, we consider long-income investing within the context of three key areas. Firstly, long leases. So by definition, long income investing is typically 15 years plus, but more often than not, 20 years plus in duration. Strong income streams are important, typically investment grade counterparty risk. This minimizes the risk of tenant default. And progressive income streams, which are typically derived from index linked or fixed rental uplifts within the lease structure. These are the elements that provide the LDI or liability matching characteristics which long income investors are seeking as part of a pension scheme. So there are three key areas: long, strong, and progressive. And these long income strategies can deliver strong income backed returns with distribution yields of up to anything in the order of 4% over the longer term. And this offers a significant income advantage over both bonds and equities, a number who stopped paying dividends through the pandemic recently. This has helped deliver consistent and strong long-term returns. And we can see this from the first graph on the left-hand side of this chart. Without performance relative to the other major asset classes over the 7-year view, and solid returns relative to both equities and bonds over the shorter 3-year timeline also. Real estate's therefore able to perform the classic risk diversification function within pension scheme portfolios with an overall return impact which is positive and a low correlation to both bonds and equities. Looking at the second chart on this page, when we drill into real estate returns, it's further evident that the long income segment has performed better than the wider market over both the past 12 months, but also over a 3-year period, showing the importance of a low risk, long-term income-backed strategy during times of market turbulence of the like we've seen more recently. So if long income investing can be part of the solution, how do we go about managing the very specific risks associated with investing into the commercial real estate segment? We need to look at how we manage the risks. Now, the risks in real estate investing here in the UK can be broken down into two key areas. Firstly, capital value risk, and secondly, income risk. We'll come back to that in a minute. But firstly, capital value risk. Commercial property is a real asset. Whilst land appreciates over time, the buildings that sit on the land are subject to depreciation or obsolescence. The real estate investor must aim to flatten the depreciation curve by managing this risk, which can take many forms. Now, if we look at the picture on the top left-hand side of this chart, you see a shiny, modern, new building. And that's how every building starts its life cycle as a brand new development. Inevitably, every building also finishes its life cycle as a rather derelict, run-down, decayed asset, rather like the picture on the right-hand side. And it's managing that journey from the left-hand picture to the right-hand picture, which will deliver you outperformance. Typically, depreciation will be measured broadly in a straight line basis from brand new to old, defunct, and obsolete. That may take 40, 50, or even 60 years, or perhaps even longer. But as a real estate investor, it's incumbent on us to seek to flatten that depreciation journey. If we can flatten the curve, we can extend the life of the building. By extending the life of the building, the physical asset depreciation that happens each year is minimized. If we can do that at the same time as investing into sites or buildings that sit on sites where there is underlying residual land value growth, we're helping to flatten the overall depreciation curve. And if I can give an example of what I mean, if you take an industrial building, like the building in the picture on the left-hand side, and you imagine that being built in a London suburb on a currently industrial site, but surrounded by residential and higher value uses. Although the building will depreciate and move much more towards the right-hand image over time, you will still have that appreciating land value. And that appreciating land value, particularly if it's in a higher alternative use, such as residential, will again lessen that depreciation journey. And these are really important elements for a real estate investor to grapple with. Other forms of depreciation at the building or physical asset level can be seen in terms of ESG or technological depreciation, or even structural depreciation, with certain segments of the market, such as department stores or high street retail, becoming redundant through structural change in the economy. We can help future-proof our assets today for the market tomorrow by introducing ESG concepts in our new buildings, by seeking high BREEAM or Fitwell or neighbours ratings. And it's actually been proven through various studies now that investors who future-proof their assets with strong ESG credentials at the development phase enjoy valuation premiums over their un-ESG counterparts. And a recent study suggested that could be anything between 8 and 18%. So these are all ways and tools at the disposal of the real estate investor in which you can manage that depreciation curve, either through capital expenditure at day one to future-proof and create that sort of green depreciation curve over a longer period of time, or through the life of the asset where you're re-future-proofing perhaps halfway through the life and again extending its life cycle. The other key component for all income managers or commercial real estate managers, particularly in the long income space, to have regard to is income. Income represents the other critical component of total return. It therefore follows that if you can collect and grow your income over the longer term, you stand a really good chance of achieving your performance goals. A large part of achieving success in managing income risk is acquiring the right assets in the right locations that hold a broad tenant appeal. However, beyond acquisition, it's important to manage and mitigate against income risk through the life cycle of each investment, which may well be over an extended period of 10 years or possibly more. And the way we achieve this is via a sophisticated toolkit, some of which you can see highlighted on the right-hand side of this slide. You're working with third parties such as EY or Dun & Bradstreet or MSCI or indeed Incans, all tools that we have at our disposal to assess, manage and monitor tenant credit risk within our portfolios on a daily, weekly, monthly, quarterly basis. And this is critical to our performance over the longer term, particularly where we're looking to liability match and deliver consistent income growth. But the following three principles are the most important of all and should really be the guiding light for all commercial real estate investors in the core income space. Number one, you should ensure that you maintain an investment grade credit counterparty risk across your portfolio at all times. This involves a requirement for active management. You just can't sit back on your laurels and say, well, I bought an investment grade tenant, so it will always be that way. You need to actively monitor and manage. And if tenants fall down the pecking order or the risk spectrum, then you need to look at moving those assets out or where possible, securing stronger counterparty risk moving forwards. Number two is to actively manage your top-down sector risk. So in other words, make sure you're swimming with the tide rather than against the tide. For example, at the moment, an overweight to the outperforming logistics or food retail segments is a sure way of ensuring that your tenants are going to be doing well and paying you rent. Similarly, if the lion's share of your sector exposure is to shopping centres or secondary offices, in other words, segments of the market that really struggled through COVID and post-COVID, then you're likely to face some challenges on rent collection and tenant solvency. So it's really important that you don't try and beat the market, but you go with the market rather than creating your own headwinds. So pick the right sectors and make sure you've got the right tenants within those sectors. And then finally, the third real maxim to follow is building strong landlord and tenant relationships. We sometimes forget that real estate is a physical asset. It is physically occupied by a real business. And those relationships need to be nurtured and grown over time. And the landlords who attentively look after those landlord and tenant relationships and treat them as partners in their business rather than as adversarial relationships are typically those that will win over the fullness of time. So finally, how do we manage total risk? We've talked about managing capital risk and we've talked about managing income risk. Well, at Fiera, we have our own proprietary toolkit for doing that. And you can see this plotted on the graph on the right-hand side of this slide, which is really simply looking at how the relationship between risk and return plays out on a line of best fit for the portfolio. So which assets are doing well and which assets are doing less well are measured on a risk return basis. And you can see the 10 headers down the left-hand side that we're using to measure that risk. But that's how we measure it. Other people will do it differently. I hope that's been a helpful canter through the place of real estate within the pension scheme universe moving forwards. And onto the final slide. So hopefully the last 10 or 15 minutes has been informative. If we were to ask the same question again at the beginning, would your answer change? So if so, would you be minded to invest in more or less real estate as part of your strategy than you previously thought? Thank you.
Thank you, Rupert. And now this brings to an end the presentation. Thanks to you, the audience, for watching. Bye-bye.